Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1663, and one other way to judge the housing market. Well, there are many ways, but one way is to look at home builder stocks and interest rates, of course, because these are very sensitive, just as the housing market is, to interest rates in general. But you have heard my enormously gutsy and, need I say, brilliant prediction about what will happen with interest rates. No, it's not the same bad prediction I made on interest rates 16, 17 years ago. No, this is a different kind of interest rate prediction. My bad prediction years ago, which I freely admit I was wrong. Jason, you were wrong. Yep, bad work. That prediction was that interest rates would be higher, and yet they have only gone lower. But we did have two severe economic crises in there to push those interest rates down. You never know. It's so hard to tell. Interest rates are a tough thing to predict. But this prediction, as you will recall, is simply this. Interest rates will go up because now there's almost nowhere else for them to go, right? That's the first prediction. And it will cause people with these incredible mortgages, the tens of millions of people that have either refinanced or purchased, it will cause them to hodl like the Bitcoin people that don't sell, right? That funny word that they made up. It will cause them to hold on to those properties, not because they love the property so much, but because they love the mortgage so much. That mortgage asset will be unduplicatable. It will be impossible to replicate, like the Mona Lisa, which is overrated. Until I watched a video over the weekend and I gained a new appreciation for the Mona Lisa. Do you know Leonardo da Vinci studied the facial structure of the human body? He went and looked at cadavers and studied them to see how the bones and the muscles around the smile work? Yes, that is why there is such controversy over the Mona Lisa smile. I never knew. I went to the Louvre several times. I saw the Mona Lisa and I thought, what's the big deal? What's so great about this? There actually is a lot of great stuff about it. I did not appreciate until over the weekend when I watched a little lesson to learn more about it. You appreciate things more when you know more about them a lot of times. And that is the same truth that applies to the housing market and the economy and the marketplace. You appreciate it so much more when you have a deeper understanding. And so that's what we hope to share with you here on the show. So, from Investopedia, got their little newsletter, and it says here, home builder stocks underrated by interest rates. Investors bought up shares of State Street's Home Builder Index ETF, XHB is the symbol, today, sending it to new highs. Meanwhile, interest rates climbed to yet another high today as well. Now, that, compared to what is always the right question, because that high is still very low in the overall scheme of things. And remember, people are going to hodl these super cheap mortgages. They're not going to sell their properties. That's my prediction. This is going to further constrain inventory. See, most people are thinking of this wrongly. And if they're thinking of it wrongly, they're not going to win bigly. That's how Trump would say it. And Scott Adams, the Dilbert creator, wrote a book called Winning Bigly, which was all about Trump. Another story there, we won't go down that rabbit hole, but anyway, it's kind of funny. Win bigly. They will hold these properties and they will further constrain housing supply versus everybody out there saying, oh, when interest rates go up, the market's going to crash. I know, we've heard it all over and over again, and they're not completely wrong, but they have to understand there is nuance to this. They think that when rates go up, well, the market's going to crash because people will be priced out. Housing affordability will decline. That's all true. They're right about that. But they're only looking at the demand side of the equation, not the supply side. And I say, and I'm going to be right about this, if I'm wrong, just come back and throw a pie in my face. Now, just so you know, I actually prefer pumpkin pie, because a slice of pumpkin pie in the fall with a scoop of vanilla ice cream, that's good stuff. And I don't even love ice cream that much, but with the pumpkin pie it's great. Maybe warm the pumpkin pie up a little bit after you take it out of the refrigerator and have a little scoop of vanilla ice cream. Oh, that is so good. So when you throw the pie in my face, make it a pumpkin pie, because that's my favorite. Other than that, I'm chocolate all day long, but that would mostly be in the form of something else, not a pie. Anyway, so interest rates up, right? And what this article is saying, the 10-year Treasury, right? That's the bellwether rate, right? The 10-year Treasury has been climbing strongly since the start of the year, creating a steeper, you know what I'm going to say, yield curve. We've talked all about the yield curve and what it means, and when it becomes inverted, what that means, right? We talked about that is there a recession coming? It's been a good indicator, and you'd have to dice that one up too, because there is a recession in some parts of the economy, certainly not in the housing market. Definitely on my forehead there's a recession. Yeah, I noticed my forehead keeps getting a little bigger and the hair keeps retreating, and there's a recession. I'm telling you, it's a recession. All right, that is a steeper yield curve than the markets have seen in many years. All right, now, what does that all mean? Well, the article goes on to say, as I'm just skipping down here, it will be interesting to see if this dynamic continues, even if mortgage rates, which are typically tied to the 10-year note, the 10-year Treasury, the bellwether rate, continue to rise. This would spell a bullish move in that sector. However, it would be extremely unusual. And the article says, the bottom line, as interest rates rise right along with home building stock prices, investors are signaling that they expect demand to continue. Even if the cost of borrowing increases, it would seem to be a bullish indication for the market in general, but some companies might find it challenging to manage the balance between supply and demand. Let me just interpret that for you. Here's what so many people miss. They don't get it. They don't get it. They're not too smart when they miss this. And here's what it is. They assume that there is a certain kind of a parity between a particular house and a particular buyer of that house. But that is just wrong, wrong, wrong. Why is that wrong? The article says they think they'll see demand continue even if the cost of borrowing increases. Well, yes, it will be demand, but not from the same person or the same family buying the house. You commonly get this question with this sort of very shallow thinking that, look, our brain takes a lot of energy, and I get it. Thinking is hard work. I think it's been said that of your whole body, right, all of the stuff that your body uses energy for, that instrument, the most incredible instrument in the universe, between your ears, consumes about 20% of all of the energy in your body. You wouldn't think that thinking would be such hard work, such energy-consuming work, but it is. It is really, really hard work to think. So we will typically ration our energy, and we won't push ourselves to think. It's the most productive work, it's the most rewarding work, but it also really does consume a lot of energy. So people have shallow thinking a lot of times, and they don't think about this stuff. And in this example, what they're not thinking about, the thing that is the unseen, right? The unseen thing that they're not thinking about is there's not a parity with one house, one buyer. So, for example, today, you've got someone out there looking at a $200,000 house. Maybe they're a couple and they got 2 kids, right? You know, the typical nuclear family. And so they're looking at this $200,000 house. But then interest rates tick up 1%, making that $200,000 house basically 10% more expensive. Okay, so what do? Are they still a buyer for that house? Maybe they can no longer qualify for it. So they still have to look for another house, but they will no longer be able to afford the same house with the extra bells and whistles that the old one they could have afforded had, because interest rates went up and affordability declined. That's the thing that few people really pay attention to. They somehow assume there's this parity. If you look at the socioeconomic ladder, and you've got, say, 2 ladders side by side. When I do live conferences, for those of you who've seen me speaking live, you may have seen me draw this on the whiteboard. You know, there's these 2 ladders side by side. Well, people move up and down the socioeconomic ladder, and houses move up and down the other ladder in terms of what can be purchased at what price. So the fact is, when rates rise, and if supply-demand is still out of balance, causing prices to either hold or continue to rise, even in a rising rate environment, which certainly has happened many times throughout history, if that happens, it simply means something has to give. What has to give for the home buyer? Well, standard of living. The standard of living has to decline. They're just not going to get as much as they were going to get in the past. And that's the way it works. So there's no parity between the same consistent home buyer and the same consistent home. Those things are both dynamic, they're both moving targets, and they change all the time. But if you want more money, and you want access to more money, here's what you need to do. And we just did a survey on this. Last year, just about a year ago this time, we offered a live webinar. And we're doing it again because we got some very nice comments on our survey. We had a whole bunch of clients sign up for this program. We did a survey and asked them what they thought about it. There are more results that probably trickled in since I looked last time, because we just sent it out last week. But the comments were really positive. And so we thought we should do this again. We're doing another live webinar showing you tomorrow how you can obtain up to $50,000 to even up to $250,000 in extra funding. Now, what could that buy you? Well, that could be a few more down payments on a few more properties. And it can be arranged as business credit, so it doesn't even show up on your credit report. A whole bunch of our clients signed up for this, and now that we have the survey results back, a whole bunch of our clients loved it. So we're going to do a live webinar tomorrow, and then we're going to do it again one more time this week. You just go to jasonhartman.com/fund. This is brand new. It's a live webinar. The founder of the company will be there to answer questions live. I did say that enough, right? That it's live? Okay, you got that. And we got a couple different times for you. So just go to jasonhartman.com/fund. and join us for that webinar. You will really like it, and you'll like how you can very easily obtain some extra funding for whatever you want. But hey, I would say you might want to buy a couple extra properties with that funding. But if not, you can buy something else. You can buy whatever you want. There's no requirement on how you spend that extra funding. And if you learn how to work it and work that system that they're going to teach you on the webinar, you can make that interest-free funding. It's pretty darn cool. PDC. Pretty darn cool. PDC. Yep. So join us, jasonhartman.com/fund. Now, today, this is not your usual client case study. This is Adam, who now is one of our team members, but he was a client at first, and he bought a bunch of properties, and he is going to go over how his return has been produced on his portfolio. And you're going to hear the good and the bad, and he's really got specific calculations. So you're really going to like this. You are really going to like this today. So without further ado, let's go to Adam, and let's hear a whole different kind of client case study that is way more specific. And I must tell you also that since this was recorded, this session with Adam, he has purchased a couple of other properties. One of them, he said, he reached out to me maybe last week or the week before, and he says, Jason, I think this one deal that I bought through your network could be portfolio changing. It is a portfolio changing deal. It's so good. So listen in. Here we go. Remember the webinar, jasonhartman.com/fund. And here's Adam.
You ready for the portfolio review?
Yeah, let's do it. Let's see what happened to you, Adam.
These are my personal properties. We got all the 2020 numbers in. Now, obviously, there could be a repair done. Repair could be needed between now and the end of the year. But as of yesterday or 2 days ago when I put this together, these were the actual numbers for 2020 for each of our properties.
Okay, so we're gonna see Adam's real portfolio.
Yep.
Okay.
So this is one of our properties in Jackson, Mississippi. For the year, so I'll explain a couple of the numbers. Number one, the cash on cash on the bottom right here that says 77.96. What I started doing in my spreadsheets is I have way too many data figures in my spreadsheets to begin with. But I started thinking, you know what? We look at how how the money we put into the stock market did in 2020. Why don't I look at the money that I actually put into my property in 2020 did? So I started putting in all the money for repairs and PITI, my total mortgage payment, and I just put my cash flow over it to see what percentage return on the money I actually put into the property got. So it was something I did. It was curiosity. So this property,
Adam, this is incredible. So when did you buy this property?
Beginning of 2018, maybe.
Okay, so you're almost 3 years old now. Okay, and did you refinance that property yet?
No, we haven't refinanced any of these properties.
Oh my gosh, it's going to get so much better when you refi. Do you know your mortgage rate on this?
Yeah, I'm pulling it up now. We haven't had it. The price point and the amount of money we have in it right now didn't make refis didn't make them make sense at the moment. Let me.
It might make sense now, though.
Yeah. So just so people who aren't watching can see, we have for the year we had a
people who aren't watching can see. I like that. That's good.
For cash flow on this property, we made $4,853.88, and cash on cash for the year was 77.96%, and the lifetime cash on cash. So this includes closing costs. It includes every dollar we have ever put into the property. Is 24.29%.
24.29% overall cash on cash for the last 3 years, cash on cash return. That means the comparison of how much cash you put in to how much cash you got out. Cash on cash return is a very simple metric, and that includes every dollar you've got into this. And cash on cash return this year, 77.96%. Adam, even I, who is quite bullish right now, do not believe you. So you got some splaining to do, as Ricky Ricardo would say. I love that. We got to get a sound effect of Ricky Ricardo say, Lucy, you got some splaining to do.
Yeah,
Go for it.
Look at it this way. We had 2% maintenance. Our mortgage payment is about $450 a month, and our management fee is $50. Our interest rate on it is 4.75%.
And what is your rent?
Our rent is $917.
Wow.
So, I mean, we're looking at, you're getting $400 a month cash flow on average on this property, and you're looking at, $500 a month between mortgage and maintenance, and then, or mortgage and management, and then 2% of that is maintenance on this property. So that's how you get your 78% cash on cash for the year.
Yeah, that is amazing. Yeah. That is amazing.
So that was one. Now, not all of them are this great. The other one in Jackson didn't do so hot. This one,
okay. So here we go. Now we're going to even it out and average the portfolio. Yeah. So what went wrong here?
Yeah, so we had a tenant who stopped paying and did a lot of damage to the property. And then it became vacant right at the start of COVID.
Okay.
So it was vacant for 3 months. And
not an ideal time to go vacant.
Yeah, we had to drop it.
Had it vacant 2 months into COVID, you would have been okay because the lockdowns would have lifted and you would have had someone moving in there. But yeah.
So maintenance this year with the rent we collected, it was 35%. Now, obviously, that's skewed by the fact that we didn't have rent for 4 months. But the cash flow, we lost $2,516.93. It was a negative 31.61% cash on cash. But lifetime for this property, we've still got a 4.67% cash on cash return.
Okay, so you definitely outperformed the best CD you could get at the bank by 500% or more. But let me ask you a question. Is that crazy high maintenance number of 35%? Ouch! Okay, we need a sound effect for that. The bomb. Ouch, that hurt. But with that, is that maintenance or some of that capital improvements? I would argue that I'm going to guess you're going to say that some of that is capital improvement, CapEx, that is going to last for many years to come. That's not maintenance only.
Okay, so it's every dollar that we spent on the property. Now, It was.
Well, tell us how you spent it. Just did you put in new flooring, new paint?
We had to put new drywall. We had to paint the house because they put holes and stuff.
What they do? Punch the holes in the wall like with their fist?
There were huge chunks of drywall missing from the walls. I don't know what happened.
Adam, did you file an insurance claim? That's an insurance claim.
Well, it wasn't enough to file an insurance claim, but we did file we had a judgment against them, and we went after them, and we got some money back. We came to a settlement with them.
Oh, wow, good. And so tell us about that. How much was the judgment for, and how much did you end up settling for?
So the judgment was for about $1,500, $1,600.
That's all?
Yeah, so they did it before. We probably could have gone back to court and gotten a better judgment. I think they just did the judgment before the courts closed down, honestly, and before we knew the total cost of the repairs. But we got the judgment there, and then all I did was I got the judgment and I Googled, rent collectors or,
collection agencies
in Jackson, Mississippi, found one that had decent reviews, contacted them. Their charge was $75 to start it, and then 25% of collected money. So I thought, if I get $100 out of it, then I break even.
Okay.
They went after him, and I believe we settled for about half. It was like $700 or $800 they offered to pay, and it wasn't worth continuing the fight to risk not getting that money. They said we can pay it today, so I said take it. Okay,
good. Okay,
and so this maintenance also covers the new lease up fee, so it's literally every dollar we put into it.
Yeah. Okay. So you've still made money on the property, but for this year, you got some tax write-offs there. And I'm saying that in a sort of snarky way. You don't want to ever get that type of tax write-off. But let's go on to the next property because we're already almost at an hour here.
So Little Rock, this property, we had to do some fixes to it to make it to qualify for Section 8. There were just a couple things, so it cost a little bit to get that up and ready to go. So it's still positive cash flow at $898.95. We made 11.65% on the cash we put in the property, and then the lifetime cash on cash is at 3.15%.
Okay, awesome. Congratulations. So there you're getting almost 12% annualized cash on cash. And remember, cash on cash doesn't include inflation-induced debt destruction. It doesn't include tax benefits. It doesn't include appreciation. Okay, so his return is considerably higher than that, even on the bad property that had problems. He's just doing straight cash on cash. That's a one-dimensional return rather than the multi-dimensional. Okay, go ahead. So
this is the first property we ever purchased through the network.
Okay.
It is in Memphis. We had a 4.45% maintenance on the property. We had a $3,728.36 profit for the year, a 70.46% cash on cash return for the year, and lifetime cash on cash is 34.67%.
Awesome. That is phenomenal.
So yeah, this property has been a cash cow for us.
And how long ago did you buy that one?
4 years ago, I believe.
Okay, so 4 years, yeah. So just so you know, Adam, why don't you tell them your story, how you came to know us and, came to start investing with us, and then you came to work for us. You're helping clients. You're part of the team.
Yeah, so we were introduced by Naresh, which a lot of people probably know is another one of the investment counselors. I started editing the podcasts, and I've learned about real estate some over the years. I used to work at a financial radio station, and so we had real estate shows there, and I was curious about it. But once I started editing all your podcasts and hearing all your interviews, I thought, well, this could make sense. I need to learn more about it. So I started learning more and more about it. And then one day, Erin and I my wife, we were discussing how we were actually going to make retirement work. And, the stock market, who knows? And so we thought, maybe we'll buy a property. And so I voxed you late at night one night, and you responded and told me, well, you're investing in the stock market. When's the last time you went and, checked out their books and visited their site?
Office. Yeah.
So then we decided to buy this property. Said, what's the worst case scenario? This was a cheap property. This property was $53,000 when we bought it.
Wow, $53,000. Now, if anybody lives in California or New York or, South Florida, and they're looking at that,
rent in a year.
Just incredible. Yeah.
Yeah. So we decided, worst case scenario, it burns down to the ground. We still haven't lost a ton of money on it.
Right.
It obviously would hurt, but it's not the worst case. So we bought this.
Some people, when they have a disaster like that, they make money on their insurance claim. So, it can go that way.
So, yeah, we started buying and loved it and started getting good returns. And eventually, Jason and I talked, and I thought, what, I want to help other people build their portfolios, because you look at these numbers, I'm clearly enjoying the returns that we're getting on the money we've put in so far. So that's kind of my short and sweet story. So our second Memphis house, this one had another vacancy. We had to do some repairs to it. Some of this was also like we had to replace a refrigerator on it. We had to do some make ready. We had to do some yard work on it. Like I mentioned before, we also have our lease up fee included in the maintenance, just because I should just put expenses instead of maintenance. So we had an 18.27% expense on the property. It still cash flowed $813.84. We still made 22.76% on the cash we put in 2020, and lifetime for the property, we're at 8.79% cash on cash.
Wow. I mean, if you just, even folks, let's not even get greedy here. Well, let's get greedy. We might as well. But if you can make 8, 10, 12% a year for several years, you are killing it. I mean, killing it. You don't have to make 34% like one of Adam's other properties or 76% like the other one. Just 8 to 12%, you're going to do great. I mean, now that depends on the inflation rate over that time period as well. But That's pretty good. Yeah, congratulations. Wow.
Right.
Who thinks Adam's numbers are great? And put a thank you in the comments and any questions for Adam sharing this personal stuff. So thank you, Adam. This is great.
So our final Memphis property, this one did pretty well. It had a maintenance of 0.59%. Literally all we paid for was a walkthrough inspection on this property this year. Cash flow of $3,614.92, a 39.68% cash on cash for the year, and a 22.15% lifetime cash on cash. But this property, since we've purchased it, has appreciated approximately 40%. So it was in a nice area and it's appreciated great. So all in all, for 2020, these 6 properties got us $11,393.02 in cash flow. We made 34.88% on the money we put in 2020, and we get to depreciate $17,160 on our taxes.
Wow!
So we lost $5,500 according to the IRS.
Okay, Adam. First, cha-ching, and then. That is awesome. Congratulations. And thank you so much for sharing that. That's really, it's just great to see. And by the way, folks, I didn't know what Adam was going to go through when we started this today. I just sort of leave it to him. And, this is the first time I've heard him talk about this. So that is awesome. I love it. I love it. We're spontaneous here. And Robert says, thank you, Adam. So that's great. And we're getting some other good comments. Anything else you wanted to go over, Adam, before we wrap it up? Do you have any more in your deck there?
Nope, that's it. And the next slide is just the thank you.
All right. Well, thank you to everybody. We really appreciate you joining us.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.